In past videos, we have covered many topics related to the investment of your retirement account. This video will focus on contributions to your retirement plan and assist with the question that many investors have: how much should I contribute to my retirement plan? When we refer to contributions, we are talking about the amount of money that is withheld from your paycheck to invest for retirement and is commonly called your deferral or deferral percentage. This money is tax deferred. The dollars are placed in your retirement plan without being taxed and will grow tax-free until you receive distributions after you retire. Many plans also offer a company match to help you save. You can set either a specific dollar amount to be deferred each pay period, or you can ask to defer a percentage of each paycheck into your retirement account. The maximum amount you can contribute in 2019 is $19,000, with a catch-up contribution of $6,000 if you are 50 or older. Most individuals won't need to contribute the maximum amount to retire comfortably. So what is the right amount? While every investor has unique needs that should be accounted for, like their life expectancy, pension plan, spousal earnings, percent of compensation needed to retire, Social Security, etc., there are some general guidelines. To maintain your standard of living, many experts suggest you will need roughly 80% of your pre-retirement salary. Social Security will make up approximately 40% of the average senior's income during retirement. So most people will need to make up the other 40% themselves, and your retirement plan is a great tool to accomplish that goal. To stay on track, by age 30, your retirement plan account value should be 1 times your annual salary. By age 40, 3 times your annual salary. By age 50, 5 times your annual salary. To reach these dollar amounts, most investors will need to put a total of 12 to 15% of compensation into their retirement plan starting at age 25. The good news, if your employer matches a percentage of your compensation, it is easier to reach this dollar amount. If your employer matches 6%, you only need to contribute another 6% to hit a 12% goal. Remember to include IRAs and retirement plans from previous jobs in your calculations. Let's use One America's retirement calculator to run through an example. Joe is 35 years old, making $50,000 a year. He's just started saving for retirement and is deferring 3% of his income, $125 per month, and receiving a 3% match from his employer for a total deferral rate of 6%. When he retires at age 67, assuming a 6% rate of return, he can expect to have about $150,000 in his retirement account. If he increases his deferral amount by 6% to get into the target deferral range of 12%, he will have $300,000 in his retirement account. Since the deferral is not taxed, it only costs Joe around $160 a month. If you don't have this amount, it's never too late to start saving. Good times to increase your contributions are when you get a pay raise or if a major expense is eliminated. For example, Jane receives a 3% pay raise. She goes to Paul in HR before the first paycheck of her new raise and asks Paul to increase her deferral percentage by 1%. Jane's take-home pay still increases. Perhaps Paul finishes paying off a vehicle loan. He can then add the $200 from that monthly payment to his salary deferral. Those dollars are now available to invest in his retirement. As always, Artesis is here to help you make the most of your retirement plan. We remove the stress of evaluating investments. Regardless of your contribution rate, Artesis takes the work out of retirement.